Ladies and gentlemen, the current economic climate has been nothing short of tumultuous, and I don't say that lightly. You've just heard about how the stock market and bond market have been performing, and I don't need to remind you of the implications of those numbers. It's not just about numbers, it's about your money, your future, your financial security. Now, let's delve deeper into this financial tempest and its potential consequences. The recent market volatility has been driven by a confluence of factors. Interest rates are rising, economic uncertainty is looming, and earnings reports are leaving investors jittery. The stock market has been on a roller coaster ride, with indices like the Nasdaq, Dow Jones, and S&P 500 plummeting. It's not just numbers on a screen, it's your hard-earned money taking a hit. You might be wondering, why are rising yields such a big deal? Well, consider this: an increase in the 10-year yield signals economic growth, but it also hikes up borrowing costs. When borrowing gets pricier, companies face higher expenses and, in turn, lower valuations. The tech sector, including giants like Apple, Amazon, and Google, is feeling the heat because higher interest rates make those sky-high valuations look less appealing. These companies have been hard hit. Their stock prices are plummeting. But it's not just about the giants. Companies like Tesla, PayPal, Square, and Enphase are experiencing drastic stock price changes. You heard about how earnings and revenue performances are key drivers. Now, why should this concern you? The inversion and uninversion of the yield curve are economic barometers. The curve is doing some strange things right now. Traditionally, an inversion is when the short-term interest rates are higher than the long-term rates. But what's happening is unusual: the yield curve is uninverting on the way up. This isn't how it usually goes. In a typical inversion, when the curve straightens out, the long-term rates start falling. But this time, they're rising at a faster pace than the short-term rates. So, how does this translate to your everyday life? The impact is tangible. Rising yields aren't just numbers, they influence borrowing costs and, consequently, your spending. Institutions sell stocks if they believe a company's short-term earnings and revenue are at risk. That's what we mean by shorting the company's earnings. As a result, the stocks are down. But the impact doesn't stop there. Institutions are focused on short-term results, which means that long-term opportunities may emerge. The markets are giving you a chance, even amidst the turmoil. What may seem like a crisis could be a blessing in disguise. Now, I want to be very clear here. Market downturns aren't bad. When prices go down, it's an opportunity for you. Picture it like a store, and the products are on sale. You want those prices to be as low as possible so you can snatch those discounts. In this case, we're talking about assets, not liabilities. The prices of assets are coming down, which should get you excited. But here's where it gets even more interesting. When volatility is high, it's time to buy. Now, I'm not saying you should be buying every day or every week. We're not dealing with dollar-cost averaging here. We're looking at individual stocks or index ETFs, and these opportunities don't come every week. They come once, maybe twice, a year. This is the time for you to sit tight and be patient, waiting for the right moment to strike. When volatility is high, it's time to buy. It's not a one-size-fits-all approach. Dollar-cost averaging is one way to go, but for the right opportunities, patience is key. Most of the time, you'll find yourself waiting for the right moment. What does this mean for you? Opportunities for personal growth, despite the hardship. Don't shy away from market downturns. Embrace them. Be patient, wait for the right moment, and make your move. See beyond the immediate turmoil, and understand the big picture. That's how you secure your financial future. Take, for example, Enphase, a company facing short-term challenges but holding immense potential in the renewable energy sector. Companies like this may experience turbulence, but their long-term prospects remain strong. Their balance sheets reflect resilience, even in tough times. So, ladies and gentlemen, don't see market volatility as a threat, but as an opportunity. Be vigilant, make informed decisions, and keep an eye on key technical levels. Be patient, understand the impact of macroeconomics on the stock market, and see opportunities even when the going gets tough. This is a chance for you to grow, to secure your financial future. In the end, you have the power to navigate the storm and emerge stronger. Don't let fear cloud your judgment. Embrace the market's ups and downs, seize opportunities, and embark on your journey of personal growth. Your financial security is within reach, even in turbulent times.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information. And it helps us spread the message. Sharing is caring.